Well, it's so great to see everyone again today. So I'm Robert Morris. I'm one of the directors of Morgan Stanley, joined by Paul Cox, my colleague and co-director. And thank goodness we're all in here today instead of actually tuned into CNBC, as Steve said, just because of all of the massive amounts of news and volatility we've seen recently. What we're going to spend our time together on today, we've got about 10 to 15 minutes just to kind of quickly go over what we see taking place maybe for the balance of this year. We want to touch on some of the fund structure items that Steve mentioned earlier at the latter part of the presentation, and I think we're allowing for some good Q&A at the end of this as well. So at a quick glance, by the way, just the past this prologue, so we need to know a little bit about what has taken place to unwind what we're seeing now in the market activity. The first thing that we'd just kind of call out, last year, of course, was driven incredibly strong returns, but it was primarily coming from just one concentrated piece of the market. You look at the tech sector at a 36.6 rate of return in 2024, compared to the average since 1990 of 18.4. That pulled large caps higher as well. Small caps had an ordinary year, which, by the way, you're supposed to, in classic theory, earn more from small caps than you are large caps. And the rest of the world slightly punched below its weight. So we had a good year, but on the back of a lot of the technology. That was driven primarily not by earnings, which fundamentally we really do have to take a look at what companies are earning. That's why we're investing in common stocks, is to try to get that earnings growth. We get a little bit of boost, typically from dividends, and then valuations over time have increased, but at a more modest pace. So since 1990 is kind of the normal. What we've experienced in the past 2 years, two exceptionally strong back-to-back years, about a 19.8% of that total return was driven by valuations increasing. That means more money chasing those stocks. And in particular, it's the Mag 7 that have really done that to us. A lot of enthusiasm, obviously, in the area of technology, AI growth, which we can certainly talk about later on. But the rest of the market actually exhibited a normal 10% year. And that's one of the good messages here that we have today, that we actually do believe that the earnings for the other 493 companies are really starting to play out, whereas obviously we've seen some recent challenge in the AKA Magnificent Seven. As we look here, we're not calling necessarily for that Mag 7 to completely stop earning. In fact, they're great, powerful companies. NVIDIA's still going to sell chips. Microsoft's still going to sell cloud space and software. But the growth rate of that net income is actually going to slow down or kind of normalize with what we see from the rest of the market. So the good news about today and the recent market action over last week is we're actually self-correcting some of what was the imbalance on last year. When you had price to earnings level of Tesla at 126 forward earnings. Said another way, that basically means investing $10 into Tesla would basically take 126 years worth of forward, just holding it static to basically get back to where you would have been. So it's normal to see this kind of drawdown in those peak Mag 7 companies versus the rest of the market that has been relatively flat. Now that obviously informs how we structure some of the underlying portfolios, in particular where we have the equity allocations and so forth, trying not to take too much risk on with the Magnificent Seven and looking at other areas for growth. Small and mid caps, for example, rest of world companies, for example. So let's talk a little bit about inflation, because ultimately here's one of the critical things that has changed and will obviously impact what we see for the balance of this year. So I'll kind of tell a little sort of joke here. I think the audience is of the right era to recognize Monty Python, the greatest export of the UK. So if you remember the Black Knight that obviously they were trying to slay that got in the way, that's basically what the Fed has been doing with inflation. Cut off one of the arms, But now inflation's still back saying, I'm not dead yet, and they've got to turn around and still fight inflation. So this is so handy, by the way. I love doing these presentations when there's like new news and it updates one of the figures. 2.8 was the inflation reading in December. Guess what? Today it came out 2.8. So we're still in date with this slide. But that is heavier than the overall target. The Fed ideally would like it to be at 2%. That's one of the critical reasons right at the end of last year where the market anticipated 4 rate cuts, and that was really impacting the bond market performance. The reason why that's not likely to materialize is because inflation is still stubbornly heavy. Near term, by the way, tariffs will have an impact on inflation. It takes a while to see those type of actions actually play through the economy. And because of that, we see a bond market that is likely, we're not going to get as many rate cuts, will probably stay level for the balance of this year, which is not a bad thing for the fixed income investments we have, because we actually earn a pretty decent coupon off of those. So that again provides some stability into the funds. Key drivers of inflation, I do just want to touch on this area here, wages. Obviously, this is an area that the Fed is looking at. You are starting to see now signs of companies just doing I hate to say this, but they almost term it the natural layoffs, just where at the beginning of a year, they'll just let go a bunch of people, usually 2,000 here, 5,000 there, kind of right-size some of the organization. You're seeing that come out now in earnings announcements, and you're also seeing what's happening in the government sector too, where there are clearly going to be some job losses, some today at the Department of Education, for example. That we still have positive wage growth. We're kind of, unfortunately, at the beginning of this year, the main term has all been about what they call a growth scare. Will the growth that we had experienced last year be able to continue? We are on a knife edge, but most of the figures are looking still positive. There is one other knife edge to talk about, and that's the consumer. So Target and Walmart made my job here today a lot easier because in their earnings announcements, they actually discussed one of the things that we have been chatting to the investment committee about for a good amount of time, and that is, unfortunately, the rising level of consumer debt, $1.2 trillion. Savings rates, very low. So if there were a shock to the economy, we still need some of those stabilizers or shock absorbers to basically help smooth out the ride there. The consumer is still spending, but begrudgingly so, is kind of the main message. This augurs for no increase per se in earnings growth rates for this year. In fact, our firm anticipates that what was forecast in 2024, which is about a 13% earnings growth level, there won't be any surprise above that. In fact, we'll probably come in right at that overall 13, maybe a touch lower. We also don't believe we're going to see any valuation increases. Remember those charts of showing price to earnings expanding? That was last year's story. We think this year basically stays pat, which would, from this point on, at least be a fairly decent return for the market. High single digits, actually, is what we would see maybe from now to the balance of the year. But it's certainly going to be choppy with all of the vast amount of news that we're seeing coming out of the administration. It's really a lot of sea change events, and that takes time to monetize through the system. So in general, in this backdrop, a couple of the things that we like: investment-grade bonds, not too shabby to be able to earn a 5.5% coupon without some of the drama. Equities should still be strong. And then also the inflation risks, though, because of the tariffs and other policies, which, by the way, we could certainly talk your ear off about that. We do think on the Chinese side, there's a lot of political motivation, and that's where we have the greatest trade deficit. But believe it or not, China is not our largest trading partner. They're actually only 10% of the mix. Mexico and Canada are actually bigger trading partners. We just don't run as great a deficit against those. So given that, things like infrastructure, for example, some of the still inflation-sensitive investments that we have within the portfolio should bode pretty well for the balance of this year. And with that, I'm actually going to turn it over to Paul to talk about some of the model changes.
Excellent. Thank you. Where you want to allocate your capital. So very quickly, we just wanted to show you what it looks like now, what the investment lineup looks like. And so at the top, you can see that there's different pools that are based on, oh, I think the belt pack is okay. Because it's being recorded, I need to, oh, there we go, way too loud. All right. Okay, perfect. So just taking a step back for those who are on the recording, your investment committee has worked very closely with our team to streamline the investment pools. And the reason that they have taken that decision is to make it easier for you as unit holders and as investors in DJCF to understand what you're investing in and why. And so really quickly at the top, you can see we have active strategies that are based on the risk tolerances, or another way to think about it, the timeline before those funds will be dispersed. And so underneath, in the middle portion, you can see what those pools are made up of. So if we look at the balanced pool, for example, you can see that 35% of it is coming from the fixed income, color-coded down there, and you can see what makes up the fixed income pool. And 65% is coming from the equity or stock fund, and you can see that the stock fund has, it's harder to see on that screen, but it's both US domestic and international stock. Really quickly for the group, if you see down here, this slide is getting a little bit busy, but underneath, this shows you the ranges that have been built into the investment policy statement. Why does that matter? It matters because these funds need to last in perpetuity. And so the investment committee has set up a policy statement that gives us the guidelines, the barriers of how much we can invest in different parts of the market. And so you can see the sub pools, how that works for each of the different asset classes. And then just really quickly, we've also introduced in conjunction with your investment committee, a passive pool. So for those of you who eschew passive investing, you have that option as well. And one last quick thing before I turn it back over to Megan. For those of you who don't know your investment committee, they are made up of practitioners who've been in the business a long time. They are very diligent in focusing on the pros and cons of different investments. We have a lot of very lively debates, and you should feel confident that they take their responsibilities very seriously, and they're very focused on making sure that these funds are around and available for the community as needed. With that, I'll turn it over to Megan.